Okay, so picture this, right? You've got this massive warehouse, let's say outside Phoenix. Tens of thousands of GPUs all racked up, cabled, paid for. We're talking $80 billion of contracted compute capacity. Microsoft, they've signed papers with customers. Customers are ready to pay. The chips work. The money's cleared. Like everything's good to go.
And the warehouse can't turn on. That's the kicker, isn't it?
It literally can't turn on. The grid interconnection point, the substation that would actually let those chips pull electricity from the wall, it just isn't built. Amy Hood, Microsoft CFO, actually said this on their earnings call just yesterday, April 30th. $80 billion of unfulfilled Azure backlog. And she just flat out identified the bottleneck. It's not silicon, it's not labor, it's power.
They built this like amazing state-of-the-art kitchen, but nobody bothered to run the gas line, you know? And here's the wild part, Marcus. That backlog number, it was disclosed earlier. But what's really new, is the sheer scale of what the 4 hyperscalers, Alphabet, Amazon, Meta, Microsoft, committed to just yesterday. Their aggregate capital expenditure for 2026, $725 billion. That's a 77% jump over last year's record. We're talking 2.2% of US GDP from just 4 companies in 1 year. And it's all crashing up against a physical constraint that already has $80 billion piled up against it.
Wow. Okay, so let's dig into the data a little bit more, because you're saying the numbers aren't subtle. What are you seeing?
Right, not subtle at all. So ERCOT, the operator for the Texas grid, currently, their all-time peak demand is 85,508 megawatts. But their preliminary long-term load forecast, they filed it with the Public Utility Commission of Texas back on April 15th. It projects regional peak demand reaching 367,790 megawatts by 2032. Do you know what I mean? That's roughly 4.3 times current peak in just 6 years. It's mind-boggling, honestly.
That number is so large, Marilyn, it kind of triggers the brain's ignore reflex, right?
It totally should trigger the opposite. Here's the crazy part. ERCOT's president, Pablo Vegas, he attached this cover letter to the filing, actually asking the commissioners not to use that number for actual planning purposes. He literally said his own organization has concerns with using its own forecast for the 2026 reliability assessment. He said many of these large load projects utilities submitted, they just might not materialize on time, at full scale, or at all.
So the president of the grid operator files a forecast and then asks the regulator to ignore it. I mean, what's happening there?
He had to file it, right? The statute requires it. But he's also bound by physics. ERCOT can't build generation, they just forecast load. They don't cite power plants. So he filed what utilities submitted, and then in the cover letter, he flagged that the gap between what's submitted and what's physically realizable is just enormous. ERCOT's own internal estimate for summer 2026 peak is 90,000 to 98,000 megawatts. The preliminary forecast says 112,000. The gap between those numbers, that's the gap between what's been promised on paper and what the grid can actually deliver. It's a huge, huge chasm.
I really want to push on the framing here, Marcus, because the way this gets talked about, and this includes even good intelligence reporting, it's always the AI race. Hyperscalers competing, Microsoft versus Google versus Amazon versus Meta. Who builds capacity fastest? Who locks up the chips? Who wins?
Yeah, that's the standard frame. That's what you hear everywhere.
And it's wrong. It's absolutely wrong. They are not competing with each other. They are all competing against the same substation, the same gas line, the same set of high-voltage transformers that take 18 months to manufacture and then 8 years to permit and build. Imagine 4 ambitious restaurants leasing space on the same block. They each designed the most spectacular kitchen, best chefs, best menus, most beautiful dining rooms. And then they discover there's one gas main running under the street, and every additional burner one of them lights reduces what's available to everyone else.
So they could all lose simultaneously.
Exactly. They could all lose simultaneously, which is a completely different game than the one all the press releases describe, right? The AI race frame implies relative performance. Someone wins. The physical constraint frame implies absolute performance. Everybody hits the wall at roughly the same time. And the question isn't who has the best AI. The question is whether the build proceeds at all, at the pace the CapEx commits to. Microsoft alone is allocating $190 billion in calendar 2026. Amy Hood, she disclosed yesterday that $25 billion of that is just to absorb rising memory chip and component costs. Their capital intensity, the share of revenue going to infrastructure, is 45 to 57%. Amazon's projected free cash flow for 2026 turns negative by $17 to $28 billion. I mean, Meta is cutting 8,000 staff. Microsoft is offering buyouts to 7% of its US workforce. Capital is just being moved from headcount into compute. That's not like a market signal of confidence. That's a market signal of urgency. They're behaving like there's a window, you know?
They are definitely behaving like there's a window. So I want to take what you've just laid out and follow a thread that doesn't really appear in the standard analysis. The hyperscalers, they issued roughly $100 billion in bonds in the first quarter to fund this build, right? Investment-grade paper. The credit default swap spreads on those bonds, they've moved to historically protective levels.
Meaning the market is buying insurance against them. And that's where the lateral I want to draw becomes important, Marcus. What's being financialized here has a precedent, and the precedent is California water rights.
Walk me through it.
So, California allocated water rights in the late 19th, early 20th centuries, based on a system of seniority. Senior rights were treated as contractual entitlements. The legal framework allocated water as if the supply were just unbounded by physics. When the physical supply turned out to be bounded, when the snowpack fell, when the aquifers depleted, the legal system didn't just break catastrophically, you know? It did something stranger. It produced ghost entitlements. People held legal title to acre-feet of water that just didn't exist. Senior rights stayed senior on paper. The water just wasn't there. And the resolution mechanism became a secondary market. The right to claim water became a financial asset, separate from the water itself.
So you're saying the $80 billion Azure backlog is a ghost megawatt?
I'm saying the entire bond stack is being priced against capacity the grid cannot deliver in the timeframe the bonds amortize over. The mechanism is the same, right? When law and finance treat a variable as unbounded that physics treats as bounded, the system doesn't collapse. It produces paper entitlements that float free of the physical substrate, and the resolution is a secondary market in those entitlements. Project that forward 5 years. The right to interconnect, the queue position at a given substation, becomes a tradable instrument. Just like California priced senior water rights independently of the water, the grid will price interconnection rights independently of the megawatts. There's already a hint of this in the secondary market for queue positions in PJM. Within 5 years, if current CapEx commitments hold, that becomes an institutional asset class. Capital just starts trading the right to plug in. And the load on that mechanism? Always the ratepayer. The household isn't just paying for the build, they're paying the spread.
I want to challenge something here. There's this frame circulating in existing analyses, even in serious reporting, that what we're watching is system failure. The argument is the institutions just aren't doing their job, right? The DOJ task force was created in January, hasn't litigated. Commerce Department's evaluation of state AI laws was due March 11th, hasn't been published. FTC's Section 5 policy statement was due in March, it's overdue. Bank regulators carved generative AI out of the model risk perimeter. The frame is, this is a breakdown.
Yeah, that's the standard read. I mean, that's what everyone's thinking.
I think it's wrong. These institutions are not failing. They are operating exactly as designed. Announcement of authority without execution of authority isn't a malfunction. It is, in many configurations, actually defunction. Authority that is more valuable as a threat than as an exercise just gets held in reserve, deliberately. The task force exists, it doesn't litigate. The existence is the policy. The commerce evaluation is overdue, it is not published. The non-publication is the policy. What looks like dereliction is, in this reading, signal management.
I have to push back on that, though, because you're letting the institutions off too cheaply, I think.
Push.
The 36 state attorneys general coalition that signed that November letter opposing federal preemption, that's not a normal procedural disagreement, Marilyn. That's institutional actors coordinating defensively against the federal apparatus. The 99-1 Senate vote to strip the preemption moratorium from the One Big Beautiful Bill Act earlier this year, that's the legislative branch registering the executive's behavior as illegitimate. The CDS spreads on hyperscaler bonds at historically protective levels, that's the market pricing structural risk. The Cauchy Elect PRAU contract trading at 45 cents, that's capital pricing the divergence between policy and physics in real money. Those aren't signals of a system working as designed. Those are signals of a system institutional actors and the bond market have, I think, lost confidence in.
The strongest version of your argument.
The strongest version is when the Senate votes 99-1 against the executive, when 36 state AGs coordinate against federal preemption, when bond markets price protection. The system isn't deferring, it's fragmenting. And fragmentation, sustained, is failure. Not collapse, no. Failure. The slow kind.
Here's the test then, right? The Federal Reserve published a working paper this winter, co-authored with Northwestern and NBER, validating Kalshi's order book as a forecasting benchmark. They found Kalshi had a perfect forecast record for FOMC decisions the day before meetings, beating Fed funds futures. That paper exists. The institution with supervisory authority over banks formally acknowledged that a public order book sees what its own surveys do not.
And
the Fed has not converted that acknowledgement into supervisory practice. The Kalshi Fed Reg AI contract, which asks whether the Fed issues new AI-specific risk guidance by June, it's trading at 62 cents. The market is pricing a 62% probability of action. If the Fed acts, your argument that this is failure looks correct. The system is correcting under pressure. If June comes and goes without the RFI, my argument that this is design looks correct. The institution acknowledged the signal and chose not to act on it. We have like a 30-day window.
That's a fair test. And I think the test reveals the question is wrong.
How so?
Failure isn't a state, Marilyn. It's a threshold. We're not watching a system that is failing or working as designed. We're watching a phase transition that hasn't resolved. The DOJ has authority currently in reserve. The commerce evaluation is overdue, but not foreclosed. The Fed has acknowledged the signal, but not acted. The state AG coalition is coordinated, but not yet operative. None of those positions are stable. All of them are observable. The question isn't, is the system failing? The question is, over the next 60 days, do the actors with reserved authority exercise it or continue to defer? Each individual decision moves the threshold. The cumulative trajectory is the answer.
So the honest read is we are inside the transition, and the resolution depends on choices not yet made.
Exactly. Specifically, the Fed's RFI, the Commerce Evaluation Publication or non-publication, the DOJ Task Force's first litigation or continued non-litigation. Each of those is a discrete, observable event in the next 60 days. The aggregate of those events is the answer to your question. So here's what to do with this, right? The dashboard you're being shown, the AI Act compliance deadlines, the deep fake controversies, the watermarking debates, it's not predictive of the next phase. The dashboard that is predictive is small, it's public, and it arrives on a fixed schedule. ERCOT's monthly outlook for resource adequacy, covering August 2026, is scheduled for release on the first Friday of June. That's like 2 weeks out.
Okay, so what are we watching for then?
If the reserve margins in that report come in tighter than ERCOT's May 2025 Capacity Demand and Reserve Scenario 1, the Kalshi ELECT PRAUG contract reprices within 24 hours toward the 55 to 70 cent range. That repricing is the signal that capital has read the constraint as binding. Watch the Mora, watch the Kalshi tape immediately afterward. That is the dashboard.
Sit with this for a second, Marcus. The Federal Reserve published a paper saying the order book sees what their surveys do not. Then they did nothing with the acknowledgement, right? The institution charged with supervisory authority formally observed that a public market is doing forecasting work the institution's own apparatus is not, and declined to integrate the observation into practice. That is not a failure mode. That is not a design feature. That is a category that just doesn't have a clean name yet, you know? It's the institution registering reality and choosing not to act on its registration.
which is a choice.
Which is a choice. And the choice gets made again in June, when the Fed Reg AI contract resolves, and every quarter the DOJ task force does not litigate. Each of those moments is an actor with authority, exercising it, or holding it in reserve. The trajectory is the sum of those exercises. The Mora drops the first Friday of June. The order book is public. The Fed's authority is documented. What happens next, though, that's not.
All right, before we conclude, we truly want to thank our viewers for tuning in. Please consider liking, commenting, subscribing, or sharing this episode to help us grow our network with these crucial insights. So, Marilyn, we've identified this real dashboard of discrete, observable events. It feels like we're at a pivotal moment with authorities held in reserve and the future hinging on these upcoming decisions.
Absolutely, Marcus. The next 60 days aren't just observation. It's a critical window for institutions to act on acknowledged reality, or risk accelerating fragmentation. The stakes are incredibly high for future grid capacity.
And that's why tracking these specific data points, the MORA, the Fed Reg AI contract, the DOJ's initial moves, is paramount. Individual decisions will define this trajectory, not broad trends.
Precisely. The system isn't passively registering reality. It's actively choosing how or if to integrate it. That, I believe, is the most unsettling aspect of this transition.